Appreciation means that the value of the real estate is higher. You bought this property for $2.5 million and now it's worth $5.5 million and you got this new $2.5 million of appreciation. But in order to understand appreciation, I want you to understand how appreciation actually works, especially in the real estate game, the investment real estate game, I should say. In the investment real estate game, generally, the value of the property, this number right here, is going to depend on this number right here. Now, I know a lot of real estate investors like to buy properties for the goal of being able to sell it for a huge profit in 3 to 5 years. That's not my goal. My goal is to generate cash flow. If the property values go up, great. If the property values go down, oh well, I'm still getting my cash flow. But what you want to understand is that this value of the property is generally based off of this net income, because you take this net income and you divide it by this number, the cap rate, and that gives you the value of the property. Now, there are two ways to increase the value of this property. You can increase the net income, or you can decrease what's called the cap rate, this cash on cash return. To increase the net income, there are two things that you can do. You can increase the revenue, or you can decrease your expenses. Or I guess you could do both. Now, when it comes to increasing your revenue, how do you do that? Well, you can increase the revenue by increasing the rents. How do you increase the rents? Two ways. You can increase the value of your property, meaning you can do a renovation, you can install better appliances, you can make the flooring better, you can add in a better kitchen, a better bathroom, you can make the units a nicer place to be, and that will allow you to generally charge more money for rents, assuming that the market can accept those higher rents. There are always times where the markets can't absorb the higher prices, but assuming you are in an area where you can raise the rents, if you can improve the property on the inside, you can make the units better, that will allow you to raise your rents. The second way the rents can go up is just based off of economic demand. If you are in an area where the city is booming, the neighborhood is booming, more businesses are coming in, and everything is coming around your property, now, naturally, people are going to want to be there because you are in the middle of everything where everybody wants to be. So there are two ways to increase your rental income. Number one is you got to make your unit better. And number two is the area, the neighborhood's got to get better. You can't control the neighborhood, but this is where when you're looking for where do you invest your money, well, if you're looking in areas where the money is moving into, that can help you also increase the rents. That's where then you can look into how do you decrease the costs. Now, I don't recommend you try to be a penny pincher and try to take away all costs that are going to hurt the property, because now if you become negligent as a manager, if you start to just remove amenities, that's going to make it less attractive for a tenant. So when I talk about reducing costs, it's more about being more efficient with your costs. Are you overpaying on some of your items? Can you renegotiate some of your contracts with some of your vendors? Are there ways for you to reduce some of your costs that way? So now, if you can increase the revenue and potentially lower the cost a little bit, you will have the ability to potentially increase your net income. So now let's assume that you can take a net income to $160,000 over the course of a few years. What happens now? Well, if you take this $160,000 and you divide it by 5%, that means that now this building is no longer valued at $2.5 million. Now this building is being valued at $3.2 million. So you can start to see, well, if you can increase your net income, you can make more money on the appreciation. But what if now, instead of dividing this number by 5%, you can divide it by 4%? How do you get a lower cap rate? Now again, this is going to depend on a couple of factors. You can try to lower the cap rate by increasing the value of the property, by making it a more desirable property, to make it much more updated and renovated. However, sometimes this cap rate is out of your control. This cap rate also takes a look at the market around you. How much in demand is the area? Generally, the cap rate is a measure of risk. The higher the risk, the higher the cap rate. The lower the risk, the lower the cap rate. And what kind of pushes risk? Demand. If you are in an area where everybody is moving to, where you have a ton of potential tenants, where people want to be, where everybody wants to buy a property, now that cap rate starts to go down. So again, if you are investing in an area where the growth is going to, where people are moving to, where the money is moving to, where businesses are moving to, not only can you increase this net income, but you can also lower this number right here. So now let's see what happens. If you take this $160,000 and you divide it by 4%, now that means your property is worth $4 million because you were able to reduce the cap rate. And again, sometimes this is out of your control. This also depends on market factors. It also looks at interest rates and mortgage rates and everything going on. So you got to pay attention to what's going on around you. But if you can go into an area where cap rates are going down, where you can increase the net income, now you can win both ways. Now let's talk about how do you actually get this money in the appreciation, because if you buy this property for $2.5 million and now it's worth $4 million, that's $1.5 million of equity just sitting there. How do you actually get that money? Now there's a couple things that you can do as a real estate investor. Number one is you can do a cash out refinance, which means now you can pull out, let's just say $3 million in debt out of the property. And if you pull $3 million out, well, now you have no equity, you have no actual cash in the property. And now if we pull $3 million out, you don't have any of your own money in the property. This property is now being funded by only the bank's money, and you still have $1 million worth of this invisible equity. And now you have all of your cash back, and you can do whatever you want with the money, because when you do a cash out refinance, it is tax-free because it's not actually income, it's just debt. However, more debt comes with more risk, as always. So that's something you want to consider, that anytime you take on more debt, it also comes with more risk. And you also have to look at what your mortgage payments are going to look like. And that's going to depend on what interest rates are. If interest rates continue to stay high, well, maybe you'll be underwater month over month, or maybe you'll be losing cash month over month if you take on a lot of debt and your net income can't support that. So you got to understand kind of the markets depending on what you want to do. Option number two is you can sell the property. Now you can sell this property for $4 million, and now you have $1.5 million worth of profit. That's taxable. But real estate comes with a special tax exemption called the 1031 exchange. You do not get this in the stock market, for those of you that are wondering. And what the 1031 exchange says is that if you sell your property for a profit, you bought it for $2.5 million, you sold it for $4 million, you got $1.5 million of profit. If you take all of this money, you take all $4 million, and you go out and buy a new property, a bigger property, a property that pays you with more cash flow, you can pay $0 in taxes today. Now I'm telling you this as an attorney who's not your attorney, but you need to understand that this does come with a lot of regulations. So if you do think about doing this 1031 exchange, it's not just something you have to do. You have to get a 1031 specialist. Make sure you talk to your accountant. Make sure you talk to your attorney before you do this. However, now you can take this $4 million, go out and buy an even larger property that's generating you even more cash flow, and you don't have to pay a penny in taxes. And the nice thing is you can do this again and again and again. You can flip this property now for $6 million, take the $6 million, go out and buy a bigger property. You can now take this new property and sell it for $10 million, go out and buy a bigger property. And you can do this until you die and never have to pay a penny in this type of capital gains taxes. Again, there are a lot of regulations around this, but it's another way for you to kind of pull your money out of the deal without having to pay taxes and continue to sell your way upwards. Now, you just got to figure out what's the right way for you. Either you can hold on to this property and not have to worry about any of that, and now you just continue getting the cash flow. You can do a cash out refinance and then have to deal with the additional debt and the risk with the debt, or you can sell it and do a 1031 exchange. And of course, I guess you could sell it and not do the 1031 exchange, but the options are really there for you. And this leaves you with the option number 3 to make money, which is through depreciation, which is another tax rule that is special for real estate. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.